just when people want to get into the metal, silver, especially silver, the supply is really going to start to fall. And this is going to be like the worst of both worlds, really. Declining production and an increasing price. It sounds so counterintuitive, but it's been 50 years in the making.
Hi, this is Mike Maloney, and with me on the line we have Steve from SRS Rocco Report. Steve, how you doing?
I'm doing great, Mike. It's a great day. It's a beautiful day, and we got crazy things in the market, so it's great to be here.
Yeah, well, we were talking just a little bit before we started the interview here about the totally illogical economy, the illogical markets, about people getting in right here at what I believe is, we're right at the top. To me, all the alarm bells are ringing that were ringing in late 1999 and in 2007. The market internals, all of the indicators, there is no reasonable measure of assets that does not show stocks, bonds, and real estate all being in hyper bubbles right now. And we were talking about that there's probably a distribution dome going on right now with the smart money placing all the stocks and stuff in the hands of the weaker investors. And so give me your take on the general economy right now, what you think is going on.
Well, if you listen to different analysts, I think Gerald Celente was talking about it. You travel around the country and you see things are much different on the ground than they are on TV, mainstream media, as well as the financial networks. So we see a huge disconnect between, now there are a lot of people moving around. There's a lot of people buying cars they really can't afford, buying boats and RVs and new homes and all that. And there's a lot of debt being put into the market. So there is a lot of movement happening, but it's not sustainable. And so over the last 3 years, the earnings of the S&P and Dow really haven't gone anywhere. They're about the same or maybe even a little less, but the stock indexes have really increased. Now, the important thing for your listeners to understand is that these markets, even though they're totally insane now, they are propped up. They are a bubble. And the reason why they're a bubble is because they're backed by debt. And I said this before, the U.S. debt has increased 23 times since 1980. Well, if we look at the Dow Jones, it was 865 points in 1980. Today, it's almost 21,000. Well, you divide those two, they're 23 times higher. So what a coincidence we have there. And the Dow Jones and our public debt have increased at the same ratio. The S&P is now up 22 times. And the U.S. retirement market, Mike, is up like 24, 25 times. So basically, these markets, especially over the last 8 years, have really gone into bubble territory. And I do agree. I believe smart money is getting out. And we're seeing a lot of, unfortunately, pension plans, they can't fund their payouts. So they're going into very high-risk assets because they need to get a high return. And we know these high-risk assets are the subprime auto. They're packaging those, and they're selling them to the pension market. And they're also the pension market is also purchasing shale oil and gas assets, investments, because they pay a higher return, but they're very risky. So unfortunately, Mike, I agree with you. It looks like the Dow Jones is continuing higher, something like 400, 500 points in the last 2 days. But this will not continue on for long because it's propped up by debt, and we're getting to the point now where the debt and the leverage is becoming unsustainable.
Yeah, and this crash, when it happens, I don't think we're just going to bounce right back like we've done in the past. You mentioned the pensions, and you did a great article on the retirement Ponzi scheme. The U.S. Ponzi retirement market is in big trouble is the title of the article. And I've been following this for quite a number of years. I wrote about it in my book back in 2007 and 8, and I've been making presentations showing the baby boom demographic. And you focused on a lot of defined benefits, pension funds, and so on in your article. But we have the same problem. We've got 25%, a quarter of the U.S. population was born between 1946 and 1960. And the people that were born in 46 they're reaching the age right now where they have to take mandatory distributions from their IRAs. But, the ERISA Act, a law that basically says there has to be a stock market crash, that isn't all of it. There's a whole bunch of people that don't have IRAs and they're invested in the stock market. And someday or another, this generation will work a little bit longer, but someday people do have to retire. They just get old and sick and they have to sell their assets to live off of them. And when you've got a much smaller demographic, a smaller population following them that doesn't have as much wealth, that means there's more sellers than buyers. Markets have to crash.
No, I agree. And that article you brought up, what's interesting is that in 2014, the Investment Company Institute showed that the total contributions were like $374 billion, but the benefits that were paid out, and this was 2 years ago, were like $402 billion. So there was like $29 billion more paid out than came in. Well, as you and I know, this is typical of a Ponzi scheme, because in any retirement plan, I don't care if it's a pension plan, I don't care if it's a private defined contribution plan, if it's an IRA or 401k, it doesn't matter. There's no huge pot of gold where they're going to say, okay, Steve or Mike, here's your part of your pot of gold, we're going to sell it off and give it to you. It's based upon earnings, and you know this, and the problem is you need future contributions or future earnings from the future payouts to pay for all this. And so, unfortunately, banks today don't really have assets. They have debts. And so the same thing with the retirement market. There's no pool of real assets in there. Because, as I mentioned, I gave you an example, how our debt has increased the same as the stock market. Basically, these assets that are in these retirement accounts are backed by debt. Well, that's a horrible thing, because the simple arithmetic is you take your assets and you minus your liabilities or your debts, and that's basically your net worth. Well, if you look at these figures here, we look at the assets and look at the debts, you minus them out, there's really nothing there, Mike. Mm-hmm. That's the reason why I've always been a big proponent of gold, because you see, gold and silver, they are true assets. They are stored, as you mentioned, economic energy. So I do agree with you. I think the retirement market, once the pension market really starts to fall apart, Mike, I see the private 401ks, IRAs, I see them not too far after starting to fall apart as well.